Okay, what is going on, MegaWhale team? Welcome back to the channel. Thanks for tuning into today's video. We have a lot to talk about today. We're going to be talking about the CPI. We're going to be talking about interest rates, inflation. We're going to be talking about the economy. We're going to be talking about the market. We'll be talking about short-term, macro, absolutely everything you think about, we'll be talking about today. Before we go ahead and get started, go down to the pinned comment down below, click the link, join our Telegram channel, and get access to all of our posts, all our updates, analysis, polls, videos, a whole range of other things. And if you're interested in our VIP channel, you can obviously contact me through there to get access to that. In the last 24 hours, we've done about 700% profit with 3 trades doing more than 200% alone in this channel. Let's go ahead and dive right in. And we're going to start the short-term analysis, and then we'll go ahead and talk about the CPI and talk about the economic stuff at the end of the video for people who've already watched that. So on the short term, guys, we've broken out of this downward descending channel formation. And this descending channel formation has been kind of forming since about a week ago, the 9th of July, and we saw this pretty significant drop down from that level all the way down to the support line, about 11 to 12% drop down. And we pushed upwards and broke out of this descending channel, which caught a lot of people, in longs over here, which was handy because we took a 300% profit on this one over here on Ethereum. But we saw this significant crash down right as CPI numbers released. And obviously that was because CPI released significantly higher, so about 0.3% higher than expected at 9.1 instead of 8.8 forecasted. So we saw the markets react poorly. Of course, we talked a little bit about that in the previous video, which we'll go in and show you again in this video, but it is an indication of systematic risk. CPI doesn't directly affect systematic risk. So if CPI increases, it doesn't mean that the systematic risk has increased. It's more or less that because systematic risk has increased, CPI has increased, and therefore the market reacts poorly. We talked about the correlation between systematic risk and asset prices in the previous video. And again, we'll show you at the end of this video how those are correlated. So coming to a short term, guys, we are in a rising wedge. And this is where it gets pretty interesting for analysis and a little bit tricky for technical analysis. I feel like this is where a lot of people get stumped because we have multiple patterns playing out here on multiple timeframes. And a lot of people are thinking, well, which time frame do I care about the most? And obviously, the larger the time frame, the stronger the pattern, the more important the pattern. Now, it doesn't necessarily mean we're going to see the entire pattern play out, but we are in a symmetrical triangle formation over here, represented by this dotted line of resistance. There's dotted lines for resistance. This is our resistance zone. Of course, this is the zone that we need to break above for us to become short-term bullish. We'll come back and talk about that one in just a moment. And of course, this uptrending support line, which we see at the bottom, acting as that base of support, which we wick down below, closed above on a 4-hour, really bullish, really nice to see before pushing back upwards. Now, here's the thing. On the short-term time frame, we are finding resistance at this level at 20,400, a very major resistance zone. We can see that as a resistance zone as the VRPV is showing some increase in trading volume around that zone. We do have a gap over here, sending us back to $20,000. Now, knowing that we are in a rising wedge and we do have a gap to $20,000, it is quite likely that this breaks downwards from here to this point of support around $20,000 to $19,800. Obviously, a rising wedge is a bearish pattern. It will result in a breakdown more often than not, about a 67% chance these actually break downwards. And these are quite strong reversal patterns in essence too. Rising wedges are quite bearish patterns. So we've broken out of a bullish reversal pattern, which is a downward consolidation to a bullish upside break on the descending channel. The measured move for that, of course, is the distance between basically the width of the channel. We apply it to the breakout. We actually exceeded the breakout target for that. So technically, we can ignore this pattern now. This pattern is a tick. We've had the breakout. We've had the measured move succeed. We've had an exceeded expectation from the breakout. Now we're focusing on a smaller time frame on this pattern over here. Of course, if we do break out of this pattern, we flip this short-term it's still short-term, but major resistance above us. We'll be heading back up to our dotted line. All right, we can see the VRPV indicating massive resistance around this level. Of course, that lines up with that dotted trend line, guys. So if we do break above here, we get a 4-hour close. We're looking for longs. We're looking for a push upwards. Until then, a downward move back to this level and potentially underneath it again is very, very possible. So that's the short term, guys. We'll come back and talk about more of this in a second. Let's go ahead to the macro chart. And obviously, nothing much has changed since the last video. All we've had is volatility. I think it's really important, guys. If you're worrying, if you're stressing out, if you're thinking, what the hell's going on? Just remember, the price is pretty much exactly where it was. Nothing has really actually changed in terms of macro since the last video, everything remains pretty much the same. We're still finding support at 18,000. There's still a possibility we wick down to 16,200, 16,500 as a fake out and push back over. We still have the 300 moving average as massive support, which we can see over here within that range. And obviously we still do need to break over the 200 moving average, sitting at 22,700 to represent that flip in the trend. Now there's quite slightly just above this dotted trend line, 22,700. So what would it take for us to flip bullish again in the short term, or in the macro, should I say? We would need to break this downward trending dotted resistance line, push upwards to $28,000. That would be our short-term flip. Now, for us to be a medium-term flip, we need to break the macro descending channel that we see over here, and this could propel us upwards. If we go ahead and take a measured move analysis, again, just from, we can just take a width analysis, we can see the breakout point would take us over this major resistance at $37,000. The measured move taking us up to this local top, which is acting as the major bull market resistance at $48,000. And if we flip the $48,000, we can see instantly volume is in a downtrend over here. We will move to a new all-time high. Very, very straightforward. Now, a lot of people are panicking. A lot of people are worried that we are going to go lower. Obviously, the economy is very weak. And I don't want to talk about that too much right now. I'm going to leave a clip at the end of the video talking about all of that. But it's very, very important you keep in mind that a lot of the indicators that governments will use to tell you whether or not in a recession or not, they are lagging, all right? And the easiest way for me to explain this is that markets move at different speeds. And if we apply like I would say an analogy, is that each indicator is like a moving average, right? You've got 9-day moving averages, you've got 300 moving averages, and they're different speeds. They show you different speeds, all right? So you have shorter term moving averages, you have longer term moving average. Some react faster, some react slower. So if you're basing what you count is a recession on a very, very slow moving average, by the time you've reached that point, you've already seen a significant pullback in the markets. That is kind of what's happening here. So by the time they admit, we're actually in a recession, the massive downtrend has already happened. You've already got wrecked. And that is why I've been telling you, you can't rely on slow moving averages to wait, because if you were relying on the 300 now before you say, oh, we're only in a bear market if we're under a 300, well, then you'd still think we're in a bull market, and then you would have held this entire time. And that is why I told you up over here, you have to use these macro structures to predict where or not we're actually going to be finding resistance, and then what that can lead to, and then your next support zones. We're going to talk about more at the end of the video. Anyway, let's talk about the CPI. And this is the CPI came in at 9.1%, guys. And obviously, you're probably thinking, well, there's no freaking way inflation is only 9.1%. And if you're thinking that, you're pretty much correct. So I just went wrong over here. And obviously, this is not the method you would use to calculate actual inflation. And the reason being is because it's not really have a way up each item. When they take, let's go ahead and show you, for example, when they take, oh, my bad. When they take, items that would be, in the basket of goods per se for inflation, so we got energy, we got food, we got oil, services, all this kind of stuff. They apply different weights to these items. So some are weighted higher, meaning they're larger, some are weighted smaller, meaning they're smaller, and et cetera, et cetera. So let's just assume they all weighted evenly. If we go ahead and do an analysis, so there's a mean analysis, we can see average inflation is actually at 21.35 to 19.76%. And what we can do to do that, we can take all of the items listed in the basket of goods, so add them all up, divided by the total amount to get the mean, and it's 21.35. And if we do that with the main item groups, ignoring the sub items over here, we get 19.76. So both of these numbers are like 2 times higher than the actually reported amount, which is 9.1%. And obviously, everyone who lives in America, I don't live in America, but everyone who lives in America would know it's definitely not 9.1%. So it's definitely higher than 9.1%. It's just the way they go ahead and do it. They manipulate it. So, for example, to keep it nice and simple, let's say, for example, in the basket of goods, they have like a $2 milk, right? They have $2 milk, and they have like a $2 loaf of bread, just to keep it nice and simple, right? Really simple. And they have like a $2, like, let's say, like, I don't know, ice cream or some shit, all right? Just keep it nice and simple. What they do, instead of, saying, oh, this one's gone up to $2.20 and this one's gone up to $2.20 and therefore inflation's, 10%, what they do is they take this bit of milk over here and they swap it out for a milk that was originally like $1.90, and then it's gone up 10%, all right? And then they say, okay, the $1.90 rise, so now it's only gone up, now it's only $2.09, and therefore we're only at 9% inflation. So what they do is they manipulate the items in which constitute or which make up that basket of goods to manipulate the number which they give you, which is the actual CPI, the inflation number. And therefore it's completely skewed and manipulated, and you can't trust it. That's what I'm trying to say. So we're definitely not at 9.1%. We're definitely much higher than 9.1%. Now, the reaction of this to the market we've already discussed, and we'll discuss later in the video, but it's essential that you understand that increasing CPI does not result in increasing systematic risk, all right? Increasing systematic risk results in increasing CPI. It's the other way around. And because systematic risk increases, we have the markets react poorly, okay? Now, just because CPI is reported higher, it doesn't mean that systematic risk will continue to increase after this point. And this is why we can't assume that just because the CPI is higher, the market will massively tank from here onwards, because we don't know what's going to happen with the systematic risk from exactly this point of release up until the next point of release. So that is why we have to still be aware that the bottom could potentially be in $18,000. And of course, if we get a significant bounce at this point, pushing over this short-term resistance, pushing over, this downward trending resistance zone over here, we could definitely push back upwards. So I think I covered basically everything I want to talk about. Again, I wanted to keep today's video nice and short. Expect a downward move on the short term. Of course, everything from our last video still remains exactly the same. We still expect a downward consolidation. We still expect the price to re-enter this resistance zone, potentially drop down to the 16,500 level. Of course, we have that short-term bearish structure. And before we head back upwards. Now, of course, we've also talked about the possibility of, a break even lower. And we've talked about this many, many times on the channel. Now, if we do see, I'm going to go ahead and bring up this chart in a second. If we do see, interest rates continue to rise, interest rates are significantly more relevant in terms of the impact on the economy and financial markets and the CPI numbers. Because like I said, the CPI numbers are a reflection where the interest rates are an adjustment. So when you adjust interest rates, you're changing systematic risk in the market. And again, you'll see this in a minute at the end of the video, but when you just announce CPI is higher, it's not an adjustment of systematic risk, it's more or less an announcement of systematic risk. And with announcements, you have initial price in, so you have the prices adjust to that, but they don't react going forward from that. But if interest rates rise, guys, at the end of the month, we will see the market continue to go downwards. And we're talking about this chart over here, and just clicking play, we're seeing we've had significant progress towards that level. We go back to our main chart on the 7-day, we can see that if interest rates do rise, interest rates are a big one, guys. The only reason we were talking about, CPI is because of that initial volatility we had to be careful about. Now it's done and dusted, we don't care about CPI anymore, we care about interest rates, because interest rates is what affects risk assets, not CPI. Remember, it's the other way around. It's a reflection, not a change. So if interest rates do rise coming forward in the next few weeks or months, whenever it is, I think it's the end of the month, we will see the prices continue downwards. If interest rates remain around the same, we'll most likely see a bottom in and push upwards. Okay, guys, we're going to go ahead and play the clip at the end of the video. If you like the video, consider liking, subscribing, sharing, whatever. Again, today's video was a shorter one. I didn't want to keep it too long. I wanted to kind of pack it in and just give you a little update. Okay, we'll catch you in the next one. Because the DXY is a visual representation of cash flowing out of assets and into, cash flowing out into assets is a representation of what's happening. So when the DXY decreases, we see a cash flow drawback into these assets, and obviously asset price rises. And when it rises, when DXY rises, we see asset prices fall. And we're going to talk about that in a second. But this is the current economic standpoint, guys. We've had, rampant inflation over the last few months, and it's expected to increase even more. And the whole reason they're increasing interest rates is to try to combat this rampant inflation. Everything's going up in price, and they're trying to combat that. So they're dropping inflation. They're hoping to drop inflation by increasing interest rates. Now, unfortunately, increasing interest rates has a massive snowball effect on the rest of the economy and economic decisions companies and individuals make, which also impact risk assets. And let me just go ahead and copy this, paste over real quickly. Cool. So interest rates rise. What does that do? Well, it increases debt on, increases interest on your debts obligation. So very, very simple stuff. You've got a home loan. If you're taking out a short-term loan, if you're taking out a long-term loan, whatever it is, if you're taking out a loan on interest, your interest repayments are going to increase, right? When interest rates rise, your repayments increase. And we've seen that already starting to happen. And we've been telling you guys and warning for like over a year now that, the housing market is going to be one of those bubbles that is going to pop because interest rates are going to rise to the point of which people can no longer afford to make their repayments. And then it's going to be a slow sell-off that's going to be exacerbated and it's just going to crumble. And we're already seeing interest rates and mortgage repayments increase to astronomical levels in the US and happening here in Australia soon as well. So what's happening with that, guys? All right, we have two things. Household income, all right, household available cash decreases. And it decreases because the debt obligations increase and inflation increases. And if inflation increases, the cost of goods and assets, or cost of goods and services, increase in price. So available cash flow is decreasing while expenditure is increasing, right? Less savings. So that puts everyone in a risk-off environment. People aren't wanting to take a risk. They're not willing to, spend a lot of money. They need to conserve their money because their debt obligations increase, their debt to service ratios decrease. What does that result in? Well, one of the things is that retail investors look to sell their assets, right? And they want to sell it to cash, right? Because they need to increase their available cash to pay off their debt obligations, as well as to move into their cost of goods and services, food, or other services that are increasing in value, right? So that's one reason why asset prices have been falling. The next big one, and the real big one to why asset prices have been falling, is because of companies, governments as well included, selling off their balance sheets. They've taken massive amounts of debt during the times of low inflation, very low interest rates in the last few years to accumulate income producing assets, whether it be property, whether it be shares, or it be cryptocurrency, whatever it may be. They've acquired a lot on debt. Now that interest rates are rising, their future cash flows are decreasing because the assets are requiring higher service ratios, meaning they have to pay more cash to keep those assets, to keep those obligations, those debt obligations, healthy, to pay off those debt obligations. And what does that do? Well, it decreases their cash flows. And if the company's cash flows decreases, their future earnings decrease. If their future earnings decrease, the stock price decreases. So we have this snowball effect where companies are now starting to increase or decrease, their holdings, sell off their assets from their balance sheet to increase their cash flows. And we've seen that happen, guys. And this is basically old news now. Everything I'm telling you is basically old news. All this stuff is very relevant, but it's already happening. It's happened. And we've been telling you guys for months, we've been telling you guys since last year that this was going to happen. And I had a lot of people tell me it's not going to happen. But guys, take a step back. If you understand the economic environment, if you understand how economic policy, how interest rates, inflation affects risk assets, affect assets in general, you would understand this is a very simple concept that you'd be able to wrap your head around. It was too obvious. It was too obvious. And I feel like because it was too obvious, people were just almost arrogant or ignorant to the fact that they believe it couldn't exist. You look at the housing market in Australia, there are people here that believe the housing market will not fall. They believe it won't drop in price, even though with everything going on, it's just ignorance and arrogance. I don't know if it's obliviousness or lack of education, but it's been so obvious, guys. It's already happening. It's already happening. It's already happening. How long will it go for? I don't know. I can't tell you how long it's going to go for, because the moment they decide, we're not going to pump interest rates anymore, everything should slowly come back. Money should flow back into risk assets. And I'm not talking about houses. I'm not talking about GDP. I'm not talking about economic growth. I'm talking about risk assets. These move faster. They react quicker. Obviously, the reason why America hasn't said, we're in a recession is because they're basing their recession indicators off much slower moving averages than what we see, what we see in the markets. So it's like taking a 400-day moving average and then taking a 100-day moving average and saying, oh, we've lost a 100-day moving average, but we're still above the 400-day moving average. Therefore, we're still bullish. All right, but in reality, we're actually short-term bearish if we've dropped that 100-day moving average, but it's like neglecting that short-term data. So short-term data is still very relative when it comes to predicting market movements, because markets move very rapidly. So if you're interested in, if you're currently trading the markets, or you've got money in the markets, your focus should be on these short-term moving averages, these short-term indicators, rather than these macro indicators that predict recessions and stuff. Because by the time they say, we're in a recession, guess what? We've had a massive drawdown already. We've suffered massive losses. The markets have pulled back so much before they've even admitted we're in a recession. So it's very important to keep that in mind. Anyway, you're probably thinking, All right, that makes sense. Let's go ahead and take a look at this chart over here. Because you're probably thinking, how does that affect Bitcoin? And we've talked a little bit about, how it affects cryptocurrency and particularly risk assets. But you're thinking, what the hell kind of relevance is this got anymore, MegaWhale? Why are we even learning this anymore? Because, like you said, everything's already happened. We're essentially late to the party when it comes to this. We should have listened to you a long time ago. And for the new viewers here, it's not really too late because there's still time to learn. There's still information you can get. And this chart is basically a mathematical reflection of what we just talked about. So we have two types of risk, guys. And the main risk we're going to focus on today is systematic risk. And systematic risk is risk out of investors' control, such as interest rates, inflation, all right, monetary policies, all that kind of cool stuff that loves to ruin you when it's going the wrong way. But when it's going the right way, it can be a great tool for a trader to help increase the portfolio return while decreasing risk. So increasing systematic risk is what we've seen over the last few months. We've seen an increase in systematic risk. Now, when systematic risk increases, we see this line over here, which is a risk-free rate, decrease. If that happens, our beta increases because, all right, we see over here, the risk on the asset increases. Now, I'm not going to show you 100% accurate. It's not going to be 100% accurate here, but we can see something like this. We see how it gets moved across, it gets moved this way. The risk of the asset increases while the return percentage potential remains the same. Now, you can see there's a big difference between the stock and the cryptocurrency, stocks and cryptocurrency. All right, stocks generally have lower betas, okay, and lower risk-free rates than cryptocurrency. Cryptocurrency is generally a higher risk asset. What this chart is now showing you is if systematic risk decreases, all right, and goes the other way, so it's hard to grab all the lines. If it goes the other way, we will see a sharper rebound, okay, in cryptocurrency than we will in the stock market, all right? And the reason being is because although there was a 0.7 positive correlation between these assets, the return is still higher for crypto as the beta is still higher no matter what happens to the systematic risk. All right, so what this is saying is when the bounce does come, when the bottom is in, when it does bottom out, cryptocurrency will see faster and more aggressive returns than stocks. All right. On the other side, cryptocurrency generally also sees faster and more aggressive downswings than stocks. It's a more volatile asset, although it is tied positive 0.7, meaning that if the market is more positive, overall, we're talking the market, the economy, systematic risk, all of it. If it's more positive, they both increase. If it's more negative, they both decrease. What it doesn't tell you is how much, but it can tell you that crypto is more volatile, it has higher beta, it will increase and decrease in higher amounts. Okay guys, we're going to be taking a quick look at Bitget, and now Bitget is where I personally trade. I highly recommend sign up to Bitget with the link down below. Bitget is probably the best exchange out there if you are a trader. It has a variety of features, and the best things about Bitget are a few things. Number one, it's non-KYC. Well, KYC is completely optional on Bitget. Now, there's a whole variety of exchanges out there nowadays that have gone completely centralized, sharing your personal trading information and information of decentralized governments and different governing bodies. Bitget allows that option to be left to the individual, to the user of the exchange. You can decide to non-KYC, you can decide to KYC. It's completely your choice. Another really beneficial thing about Bitget, and the biggest reasons why I'm sitting here actually recommending Bitget to all my followers, is that it has 0.02% trading fees. All right, this is significantly lower than any other cryptocurrency trading exchange out there. FTX, Binance, can name a bunch more. KuCoin. It is significantly lower, by 500% lower than the lowest exchange out there, Binance. Another big thing, guys, is there's no global restrictions on who can use Bitget. Anyone from anywhere can sign up to Bitget and get access to the entire exchange of all the tools, whether it be futures or spot. No matter which country you're in, you can use futures and spot. If you're in America, for say, and you want to get access to more spot trading pairs, such as Binance Global, and you can't sign up, well, guess what? They've got 250 different spot trading pairs here on Bitget to get access to, and you can get access to all of these. If you're in Australia and you want to access the futures market and you can't trade futures, you can do it here on Bitget. You can get access to the future market and start trading with leverage. And finally, guys, if you do want to sign up to Bitget, go ahead, click that link down below to sign up to Bitget, and you'll get access to the reward center over here, which enables up to $4,000 in rewards by completing 5 tasks. All right, guys, we'll get back to the video. Thanks for listening to that. Okay guys, I want to take a quick moment to introduce the Become a Trader course at the end of this video. This course was designed by myself and Wolves of Crypto. We put together a whole variety of knowledge to create the most cohesive, understandable, and beneficial trading course there is on the market. If you're interested in learning how to become a trader, if you're interested in learning how to use technical analysis, if you're interested in learning how to apply market analysis to different cryptocurrencies, this is a course for you. We teach you everything from the fundamentals, the basics about what cryptocurrency is, how to trade cryptocurrency, mastering the craft of cryptocurrency, diving into a whole range of technical indicators, market structures, and teaching you how to utilize these when finding trades and applying risk management strategies to become more profitable over time. We even dive into market psychology, human psychology, and provide a variety of different videos and educational content, including courses and quizzes to assist your learning along the way. If this is something you're interested in, guys, go ahead and contact us down below at the cryptoacademycourses@gmail.com. We'll send you an email back with all the course information, the structure, the payment details, and everything else you need to know. That being said, guys, I hope you enjoyed the video today, and we'll catch you in the next one.